So guys, today we are going to discuss about what revenue from contract with the customer. So first, it is also called IFRS 15. So there are no major changes between IFRS and US GAAP. So almost it is similar. Okay, so what is the definition of revenue? First, let me explain. Revenue means to say it is any income arising in course of an entity's ordinary activities. Like for example, if you are running a grocery store, supermarket, so your ordinary activities are what you are selling grocery related items to the customer. So whatever money you will receive or whatever the money you have a right to receive against the sale of grocery items, so that will become your what? Revenue. Understood? So maybe your business is to sell grocery related item, you are running a shop, suddenly you sold air conditioning system of the business, right? So this is not going to be your revenue. The reason because your ordinary activities are is to sell the grocery related items, not air conditioning system. You got my point? So sometimes we sell non-current assets, like other assets other than operations. So that is not going to be your revenue. So if you look at here, ordinary activities means say it is your normal trading activities or normal what? Operating activities, like it's your routine operations. Understood? Then here obviously revenue, where we record revenue, we always record in the statement of profit and loss account as the first item. You know, when we prepare the income statement, first item we record there as a sale. Sale is also called your revenue. Understood? So this is income statement relevant item, and in this topic, which we have a revenue from contract with the customer, we are. And for this, guys, we have a 5-step model, 5-step process. And what is a 5-step process? So first I'm going to explain in simple way. I need your concentration. 5-step process is what? Step number 1 is what? You have to identify the contracts with the customer. We will discuss all these steps in detail later, but just first I'm giving you overview. What is step number 1? Identify the contract with the customer. Then second is what? Step number 2, we have to identify the performance obligation in the contract. What is performance obligation? It's a promise. What as a seller you are going to sell? Are you going to sell a good or service? Third is what? Step number 3, you need to determine the transaction price. Transaction price means the price at which you are going to deliver goods or services. That needs to be identified. Next is what? Step number 4, we have to allocate the transaction price to the performance obligations. Sometimes you might sell more than one good or services. Understood? So then at that scenario, maybe the sale price of the whole contract you need to allocate. For example, maybe you are selling let's say computer, and you are also selling what? Maintenance services, right? Along with the computer. So it means there we have how many performance obligation? 2 promises we have. Maybe you sold you sold it for $200. So what portion of $200 we will take it to the computer, and what portion of $200 we will take it to the maintenance service. So this is what is called allocation, and I will tell you how to allocate. I'm just giving you overview. Then we have a step number 5. Step number 5 is what? Recognize the revenue when or as performance obligation is satisfied. You will book the revenue only when the performance obligation is satisfied. For example, if you are a seller and you are selling computers, it means you can book the revenue only once computers are delivered, once computers are handed over to the customer. So these are 5 steps. So I will open step by step, one by one. So first, initially, we have to. Now we are going to discuss here examples of this 5 step. What was the 5 step? Number 1 is what? Identify the contract. Step number 2 is what? Identify the performance obligation. Step number 3 is what? Determine the transaction price, means the sale price. And step number 4 is what? allocate the transaction price to each performance obligation in case if you have more than one performance obligation in the contract. And step number 5 is what? You can book the revenue when or as performance obligation is satisfied. So let me just give you example for this 5 step. Then we will open one by one, because from here most of the theoretical question will come in your exam. So theoretical points you need to memorize. So here we have example here, guys. Let's assume on December 20 X1, okay, Wade receives an order from a customer. So we received an order from a customer for a computer as well as 12 months of technical support. It means how many things you are going to deliver? 2 things. Number 1 is what? Computer. Number 2 is what? Technical support. Wade delivers the computer. What has delivered? Computer has been delivered, right? It means one performance obligation is done, and transfer its title to customer on the same day, right? And next they're telling you customer paid to $420 upfront. I would say advance payment he made $420. If sold individually, what it means? Like if you will sell these products individually, for example, if you will sell computer separately and technical support separately, the selling price of the computer is how much? $300, and the selling price of technical support is how much? $120. So this information is with you. Now apply the 5 stages of revenue recognition. We have to apply as per the standard. The 5-step process we have to apply to this example. Now guys, what was the step number 1? First of all you have to identify the contract with the customer. And it is not necessary that contract must be in writing only. It could be verbally also, orally also. For example, when you visit the grocery store, right? So you don't need to sign any contract with the seller. So just you will pick the item and you have to pay for that. It means contract, there is a contract. The reason customer approaches the seller and seller has delivered the computers at least on the same day to the customer. So it means there is the contract. And we will talk about more about the contract while I will explain these 5 steps. Step number 2 was what? You have to identify the performance obligations. And how many performance obligations are there? 2. One is to deliver the computer and second is to deliver the technical support. Technical support for how many years? For 12 months. I would say for 1 year. Step number 3 is what? Determine the transaction price, sale price. And sale price is given. How much is given? $420. Right? And step number 5 is what? Step number 4 is what? Allocate the transaction price. You have to allocate the transaction price. Transaction price to whom? To performance obligations. How many performance obligations are there? 2. One is what? Computer. Second is what? Technical support. And by the way, I will explain later how to allocate, but here I can just give you example. For example, if you will sell computer individually, what was the price of computer? $300. This is called standalone price. Standalone price is what? Standalone. It means if you will sell that item individually, so the value is how much? $300. And if you will sell technical support, value is how much? $120. And by the way, what was the transaction price? Transaction price is how much total? $420. So I am assuming, let's assume out of this $420, 300 is for computer and 120 is for what? Technical support. Right? Because if you will have these two values, it is also $420. So we don't need to allocate. It's already allocated. Otherwise, we will allocate. I will tell you how. Right? And now step number 5 is what? We will recognize the revenue when or as performance obligation is satisfied. So tell me which performance obligation is satisfied. Computer performance obligation is satisfied. How do you know? Because computer is delivered. So it means what entry I can pass? Double entry, if you know, If you don't know, just learn how to pass the entry. So we will debit the cash because we received cash how much? $420, right? And we will credit the revenue. What we will credit? Revenue up to the performance obligation which is satisfied. And which is satisfied? Yeah. Computer is delivered. So it means we can book the revenue for computer, which is how much? $300. And what about $120 for technical support? That is going to be my unearned revenue. Which revenue? Unearned means say like you received in advance. Because you received 120 today and you have to deliver. You have to deliver the services over 12 months. So it is kind of liability. So far it is kind of liability. Unearned revenue is also called deferred revenue. Means so far it is your liability as unearned revenue. It's not revenue. It is like your what? Liability for $120. But as each month will pass, so you can remove this liability and you can take it to the revenue. For example, our contract is for how many months? 12 months. 1 month is passed. So what I can do, I can debit this unearned revenue because I can remove the liability and I can credit to the revenue. For example, if amount is 120, I will divide with the 12 months. What monthly amount I will get? 10. So I will debit unearned revenue and credit to the revenue. Over 12 months, I will pass this entry. Understood? So this is what just we discussed. 5-step process. I hope it is clear. Understood? Now, guys, I'm going to explain step by step. You don't need to waste your time on unnecessary things. The main idea, main points I will explain. Otherwise, if you will read the revenue recognition, the standard, you can find over 1,000 pages also. If you will look, if you will read the book of any big audit firms, PwC, Deloitte, okay, they are writing books, right? Because industry to industry it is applied. What changes are there, how it is applied. So you can find over 1,000 pages also. But here we have to get the idea, and based on that idea, we will solve the questions. So step number 1, I'm going to explain now. Now I need your 100% concentration. And what was the step number 1? Identify the contract with the customers. First of all, the first definition we have here, it is for what? Contract. How we define the contract? Contract is an agreement. Between 2 or more parties. First, let me finish this part of the statement. Agreement, it is not necessary, it must be in writing. It could be in writing. Maybe you have signed with someone that what seller is going to sell and how much buyer is going to pay for that. It could be oral also. As I give you example at start, for the grocery store, when you pick the item, you have to pay the price. And it could be implied also. Which one? Implied. What is implied? For example, when you visit a restaurant, right? So you will take a menu, you will select a food. On menu, price is written. Right or wrong? Even you didn't speak with the counter, you didn't speak with the waiter, you will just tell, I need this food, right? He will bring the food for you and you have to pay the price which is mentioned on the menu. So why? Because it is implied. It is not even orally discussed, oh, how much you will charge, how much I will pay. It is not in writing, we signed, we didn't sign also. It is by default, it is implied. That if you are ordering this product, price is written. It means you are agreeing with this price. That is why you are ordering and you have to pay for that. So contract could be in writing, it could be verbal, it could be implied. And this contract will always be between 2 or more parties. Parties could be individual peoples, it could be a companies. It could be from company to individual or individual to company. Understood? And contract that always creates what? Enforceable rights and obligation. What does mean by enforceable rights and obligation? Actually, this word is derived from the law. Enforceable rights and obligation mean to say, let's assume you and I have a contract. You are the seller, I'm the buyer. You are going to sell a chairs, 100 chairs to me. Right? We agreed and we agreed the price. Now we signed this, let's assume we signed this contract. What does mean by enforceable rights? Now you cannot run away from your obligations. You have to sell the shares. I cannot also run from my obligation. I have to pay. If any one party will run from the contract, if any one party will not fulfill the obligation, his performance obligation, other party can go to the court. This is what is called enforceable rights and obligation. It can be taken to the court, okay, against the party who is not fulfilling his responsibility. This is the definition of contract. First point you have to remember. Understood? Now, when we identify the contract, guys, when we identify the contracts, we also need to understand these 4 points while identifying the contract. Point number 1. A contract was approved by the parties. Like both parties must have mutual consent to agree on the contract. If I will put a gun on your head and I will say, okay, sign this paper, is it a contract? Because both parties are not agreed. Maybe one party is forcing other party to agree on it. Okay, but for the contract to be agreed, both parties must have a mutual consent. Understood? Point number 2 is what? The contract must have what? Commercial substance. This word is important. Commercial substance. This word is derived from the framework, the substance. Actually, what does mean by commercial substance? Due to this transaction, entity's cash flow position is going to change. For example, if I'm seller, I'm the entity. Entity stands for company. I'm selling goods to you, right? If I'm selling goods to you, what you will pay? You will pay me the cash, and maybe you will give me any other consideration. It will change my what? Cash flow position. So this is what is called commercial, is having a commercial substance, or at least, in other words, it will change the position of risk and rewards of the parties. For example, if I'm selling goods to you, right, and I transfer goods to you, and risk and rewards of ownership is transferred to you. Now risk is changed, right? It is shifted from my side to your side. If the goods are damaged now, it is your responsibility. It is not my responsibility. But in standard, we can say commercial substance mean to say, due to this transaction, cash flow position of the company is going to be changed. Understood? What was the first point? Contract must be approved by the party. You have to memorize to solve the radical question. Second point is what? Contract must have a commercial substance. And what is the point number 3? Point number 3 is each party's rights. Each party means say buyers and sellers. Mainly we are studying this topic from the seller point of view. So it means seller's right regarding goods or services, okay, or regarding the payment terms, because seller is responsible to sell goods or services, and seller has a right to receive cash or other consideration. And buyer responsibility is to pay cash, but buyer's right is to receive goods or services. They are saying when you look at the contract, so you should be able to identify the rights of each party. The rights of buyer is to receive the goods or services, and rights of seller is to receive cash or other consideration. Right? So this can be what? Identified. Number 4 is what? It is probable. First, understand what does mean by probable. Probable means say there are high likely, there are high chances are there. There are high chances. I cannot say in percentages. Oh, high chance means 90%, or maybe for you high chance is 70%. For me, high chance is 90%, because it is not expressed in percentage in standards. But high chance means there are more chances. What for what? There are more chances that entity will collect. What? Entity means here seller. Seller will collect. What he will collect? Good, service or cash? Cash. Obviously, selling goods or services. So entity will collect what? Substantially. Substantially means a majority. Okay, the significant. All of the consideration. Consideration means what he is receiving. It means seller will collect. Seller will collect all of the substantial amount of consideration to which it is entitled according to the contract. Obviously, according to the contract, you are entitled. You have a right to receive the cash. It means if there is chances, you will collect the money. Only in that scenario, guys, only in that scenario, you should book the revenue, right or wrong? If you are going to steal my goods, is there any chance that I will collect your money? You are going to steal. For example, chances are 0. Can I book the revenue? Can I say this is my revenue? No, I cannot say. I would say this is like a loss to me. Understood? You got my point? So you have 4 points. When you identify the contract, what is the point number 1? Contract must be approved by the party. You have to memorize with me. What is the point number 2? Contract must have commercial substance. Point number 3, rights of each party can be identified. Step number 4 is what? It is probable that the seller will collect the consideration. Understood? Okay, now I want to tell you one more point, guys. Just be with me. Sometime, guys, you are receiving non-refundable consideration. Which consideration? Word is non-refundable. You know, sometimes you buy the goods. So they are saying, oh, sir, it is not refundable. Cash is not refundable. For example, exchange is also not possible. So, for example, I'm just giving you an example. Non-refundable revenue, a non-refundable amount I'm going to tell you. Right, guys? For example, let's assume you are a government. I'm just giving you example for the sake of understanding. Let's assume government. Okay. So you want to get a bid for construction of road from the different supplier. Right. So now there's a bidding process is open and you have to pay, for example, $1,000 just to participate in the bidding process. And it is written that this $1,000 is non-refundable. It will not be refunded to anyone. Now tell me, if you are a government, do you have any responsibility against this $1,000? No, because either the bidders will win the bid or he will lose the bid. You are not going to return this money. If there is any consideration which is non-refundable, so most of the time, so what we do, we can book this money as our revenue. What entry I can pass? Debit, cash, and credit what? The revenue. But if this amount is refundable, just you are participating in auctions of car, you are giving, let's say, $1,000. This $1,000 can be refunded, right or wrong? If you're not going to buy any car, if it is refundable, then this $1,000 is not your revenue. What it should be it should be your liability, refundable liability. Understood? What I told you? If any amount which is non-refundable, right or wrong, and project may be terminated, are you not going to transfer any goods or services against that? And this amount is what? Non-refundable. What can be booked? Revenue can be booked. But if it is refundable, what can be booked? Liability can be booked. They will not ask you to show double entries. They will ask you facts, as I'm explaining. Understood? Now there's one more point, guys, which I have to tell you. And then I will do small example with you also, because otherwise you will feel bored just by theoretical points. Under step number 1, we have one more note that is called what? Contract modification. Okay, contract modification. Guys, when we make changes in the contract, please listen to me what I'm saying. When we are making changes in the contract. For example, what changes are there? First, let's understand in the contract. Changes could be either the scope is going to change, scope of project. Scope of project means a performance obligation. What? Performance obligation is going to change. For example, initially I have a contract with you that I will sell you the computer. This was my which contract? First contract. Maybe after just an hour or after one day, you want to amend the contract. You are saying that no, sir, I don't need only computer. I need also what? Technical support. And I agreed with you, I will sell you computer for how many dollars? $100. Okay, and now what you want? You want to add technical support also. I'm saying, okay, no worry. I will provide you technical support also. Previously, I have only how many performance obligation? 1. Now the one more performance obligation is added. So this is called scope of the project is changed. Second thing, this is also change. This is also a change. Second could be what? Or. And or I'm using word. and or I'm using word, guys. Second is what? There could be a change in what? In the price of the contract. Now see what I'm saying, please. See what I'm saying. First contract was to sell what? The computer only. Later on, you said you want but technical support also. It means scope of the project has changed. Right or wrong? Because performance obligation is added. I'm saying that, okay, if you want technical support also, so I will charge $50 because this is the standalone price. If I will sell individually, I'm selling for 50. So I will charge 50 from you also. Now your total price is going to be how much? 150. But the previous price was only how much? 100. Now what happened here? Here price also has changed with the value of additional performance obligation, right? Because value has increased from 100 to 150. The increase is what? $50, which is the price of the additional performance obligation. Or I can do this way also. Initial contract was only 100 for the computer, and I told you I will provide you technical support free of cost, and price will be what? New price will also be 100. Tell me what happened here. Scope has changed, our price has changed, or both are changed. In the second example, scope has changed, but in first example, scope plus price both has changed. So this is called contract modification. Now here I want to tell you the main thing for which I was telling you. There are, guys, in the contract modification, whenever contract is modified, focus with my wording here. Whenever contract is modified, this is called changes in contract. Guys, so can we say these two questions are there? Question number one, is it a modification to existing contract? To which contract? To existing contracts. What it means? It means still existing contract is valid or not? Or this modification will be treated as what? As which contract? As new contract. New contract is also called separate contract. Understand what I'm saying? Whenever contract is modified, what we can say? Can we say, is it a modification to existing contract? Till existing contract is valid? Or we should say it is a new contract. Old contract is gone, new contract is established. What we should say? Actually, it depends. Standard guides you here. Standard guides you if only one thing is changing. What? Only one. Either what? Price is going to change, or what? The scope is going to change. But only one thing is changing. As in my example, I'm selling you computer for 100. Now you want technical support. I'm giving you free of cost. Only scope has changed, price has not changed. So we will say still it is a modification to the existing contract. Existing contract is valid. Understood? If both things will change, both what? Scope plus what? Price of the contract. And price should change with the value of additional performance obligation. With the value of additional, if both things are changing, we will say what? We have established a new contract. This point will be tested only theoretically. Understood? When we will say the modification is the modification to existing contract if one thing will change, price or scope. If price and scope both are going to change, we will say what? It is a new contract. It is a separate contract. Understood? So how it will be defined in theoretically? So here these points are written here. We will treat contract as which contract? Separate means a new. When what's written here? Look, read, because wording is important. We will assume it is a separate contract if these two conditions are met. Which two conditions are met? Number one, the scope of the contract what? Increases. Like you have added more performance obligation because the addition of promised goods or services that are distinct. What is the distinct? I will explain later. But just assume scope has changed. And the word here what? Or, and, not or. And. It means both conditions should meet, right? Second is what? The price of the contract increases by the consideration by the consideration amount that reflects the entity's standalone selling price of what? Additional promised goods or services, like that the contract price has changed with the value of additional promised obligation. Understood? If both will change, scope and price, what we will say? It is a new contract. Otherwise, what we will say? It is a modification to the existing contract. Understood? I take time to teach this topic. Reason so many theories there. So far we discussed first part only. I told you when you identify the contract, 4 points need to be identified. What was the first point? Contract must be approved by both parties. Contract must have a commercial substance. Rights of each party can be identified, and it is probable we will collect the substantial amount of consideration. Understood? Then I told you about non-refundable deposits also. Then I told you modification to the contract as well. Understood? So now this is the theoretical part. So let's move to the second step. It is a bit complicated. Maybe initially when I will explain, you will confuse it. But once I will show you example, you will get it. Ready, guys? Here we go. Now, guys, here what we are going to do, step number 2. What was the step number 2? Identify the performance obligations in the contract. There could be a one performance obligation. There could be a more than one performance obligation. What is performance obligation? Simply promises, promise of the seller, or the promises of the seller. For example, I am selling you only computer. There is how many performance obligation? 1. I am going to sell you computer plus technical support. How many? 2. I am giving you lecture, and I agreed with you. I will just give you lecture only. 1 performance obligation. I agreed with you. I will give you lecture plus books. How many? 2 performance obligation. Actually, here we are going to identify, and standards are providing us the guideline. Right? Okay. I'm giving you another example. Just I didn't say anything about performance obligation. First, I'm giving you random examples. You should get idea what we are going to study. You bought a car from Allocate, and they told you they will sell you a car, plus they will give you 5 years maintenance service. They delivered you the car. How many performance obligation is satisfied? 1. And they denied from the maintenance service. Second performance obligation is satisfied? No. But once they will provide maintenance service is over 5 years, so it means second performance obligation will be satisfied also, but over time. Understood? So it means there are how many performance obligation? 2. Car and maintenance service. If they will break any one, so we will say they are not fulfilling their contract. Understood? Their responsibilities. Agreed? Now let's understand how performance obligation is defined. Because wording is also important, and I need your concentration. This point is little bit technical to convey. Okay, but I will give you number of examples also to understand. So here we go, guys. What is performance obligation? It is defined here first of all. Performance obligation is a promise where in a contract. Obviously, we are making promise that we will sell you these goods, or this one good, or maybe plenty of goods. Right? It is simply a promise. I need concentration. What it is? It is a promise in a contract with a customer. Who is making this promise? Who is making this promise? Because we are talking about from seller point of view. Seller is making promise with whom? With the customer. For what? To transfer. To transfer what? To the customer. Like we will transfer to the customer. What we will transfer? Point number 1. A good or service. It could be a single product, a single service. But that is keyword here written what? As distinct. This word we need to understand. But so far ignore the word distinct. Just it is a promise to deliver good or service. Or it could be, second word, it could be a series of goods or services. Series of goods or services that are substantially what? The same. Series of goods or services that is substantially the same. Okay, and have the same pattern of transfer to the customer. What is the example? I'm just giving you a rough example in order to understand. For example, you contacted with Lockheed Martin. Okay, you want to buy a jet fighter from them. For example, they told you, okay, you are contacting them to buy only one jet fighter, and you agreed the specification of the jet fighter. It is one good or goods? One good. Understood? Second is what? It means it is product. This promise could be for good or a service. Second is what? It could be what? Series. For example, you contacted with the Lockheed Martin. You are saying that I want to buy 20 F-16 jet fighters. How many jet fighters? 20. They told you, okay, no worry, but 20 at a time we cannot deliver you. 5 we will deliver you in the first year. Or means within 6 months. Next 5 we will deliver you in next 6 months. Next 5 we will deliver you next 6 months. And within 2 years we will complete your 20 jet fighters. Because what they are providing? They are providing a series. Series. Right? Series of a good or a service. Okay, that are substantially the same. Obviously, they will provide you F-16 with the same specification. Not this way. First, they are providing F-16 and next they will provide you F-35. No. Understood? But now the point is, so it means what we understood from performance obligation. If you will keep it here, we said it is a promise. This promise could be for one good or it could be for series of goods or services that are substantially the same. Substantially the same. But the point, if you will go through this whole statement, the whole statement, so the word they have used what? Distinct, distinct. Now I want to explain distinct. Don't bother. Don't take tension because this is a bit hard to understand. But once I will quote the example, so you will understand what is the distinct goods and services. Okay? So you can look at here. The promised goods or services are considered as what? Distinct, and there are how many points are written? 2 points. Need concentration here. 100% concentration. We will assume the goods or the good or a service is distinct. If how many points are there? 2. Point number 1. I'm going to read with you. Point number 1. Point number 1 is what? The customer can benefit from them. From them mean to say from goods or from services. Either on their own, maybe that good or service itself will give you benefit. Or you can get the benefit by, okay, or together with what? With other resources. Maybe you're buying such a thing that you can mix with other things to get the benefit. Understood? Read the statement. Distinct means to say that good will give you by their own, they will give you benefit, or this good will give you benefit with along with other resources. And here it's written here that are readily available. Those resources are readily available. Now guys, here if you look at it, this is the keyword here. Keyword is what? That good or those goods or services are capable of being distinct. This is the key word. Don't forget the word. Capable of being distinct. Capable of being distinct means that goods or services could be bought or sold separately. Could be bought or sold what? Separately from rest of other goods or services. Okay? Understood? Can I share example here? Okay, I'm sharing example here for the first point. First point is what? We are trying to define what? Distinct goods or services. And what is the first condition? The goods or services must be capable of being distinct. First condition. Let me give you example here. And what I told you, what is capable of being distinct? It could be bought or sold separately from the rest of the products. Let me give you example here. Let's assume you are a construction company. You are a You have to understand, you are a construction company and this is your range of services which you can offer. You can provide, for example, only construction work also. What? Construction work, like just you can make infrastructure only. Infrastructure, I mean to say. You can provide flooring work also. If they want only flooring, you can sell flooring also. You can provide plumbing work also. If they want plumbing work, you can provide also. You can also provide electrical work also if they want. You can provide also maintenance service if they want. Now tell me, all these are capable of being distinct or not? Yes, it could be bought or sold separately. If you are interested only to buy from electrical work, I can sell. If you want from me only plumbing work, I can do. If you want only flooring work, I can do. If you want only infrastructure, I can do. It means these products are capable of being distinct, because it could be bought or sold separately. It means first condition is there. Right? Understood? Now I'm going to explain the second point. The word here written as or, and. It means both conditions should met. For what? That I will tell you later. And what? Can you please, I need your concentration. Second one is what? The entities promise. Entities promise to transfer them. Transfer them means those goods or services. Okay. To the customer is what? Separately identifiable. Keyword what? Separately identifiable. What does mean by separately identifiable? Separately identifiable means say. Separately identifiable mean to say. No, not separately identifiable. Separately identifiable mean to say that was capable of being distinct. Separately identifiable means say those goods or services must be distinct within the context of the contract also. Within the context of contract also. Keyword capable of being distinct and distinct within the context of the contract also. Actually, these 2 points will help you to decide, do you have one performance obligation or you have more than one performance obligation. Let me say it again. Capable of being distinct. Capable of being distinct or separately identifiable, which is also called what? Distinct within the context of the contract. These 2 points will help you to decide you have only one performance obligation or you have more than one performance obligation. How would you decide? How would you decide? How would you decide? I'm going to answer. If capable of being distinct, it could be bought or sold separately. As I told you, it is technical, because then I will give you example, you will understand. If first point is there, it could be bought or sold separately, as in my construction example. You can provide plumbing, electrical work. And it is distinct within the context of the contract also. It can be distinguished in the context of the contract also. If both conditions are there, so it means we have more than one performance obligation. See what I'm saying? Try to memorize first. If first point is there and second point is also there, we can distinguish within the context of the product, within the context of the contract. It means we have more than one performance obligation. If it is capable of being distinct, but you cannot separately identify in the context of the contract, then you have only how many performance obligation? One. Let me say again, don't confuse, I will give you example. First try to memorize. If both points are there, what 2 points? Capable of being distinct, and it is distinct in the context of the contract. It means we have more than one performance obligation. If second point is missing, then we will say we have only one performance obligation. Ready? Now I'm going to give you example. Okay. For example, let me go to the example here. Then you can read the one more example which I will show you on your screen. For example, I'm seller. and I agreed with the customer. I agreed with the customer that I will construct a house, 5-bedroom house, 5 BHK house. And we agreed specification that you want this kind of doors, you want this kind of flooring, this kind of electrical work, this kind of plumbing work. Everything we agreed. As a seller, I agreed with you, yes, I will do the same. Right? Now, please listen me. And obviously, to complete the house, what I have to do? I have to work for infrastructure. I have to do tile work, I would say flooring, etc. I have to do plumbing work, right? I have to do what? Electrical work. I have to do wood work. And I agreed a house with you. What I have agreed? House. Now tell me, you will answer the question now. Huh? Participate. Participate now. Okay, first day, I brought the bricks. Can I say my performance obligation is satisfied? Why not? Because I agreed with you. I agreed with you complete house. What I agreed with you? Complete house. Just buying the bricks is not a fulfillment of the performance obligation. Understood? Okay, then I hired the labor and I took 1 month and infrastructure is completed. Can I say my performance obligation is satisfied? No, still not. Again, it took 1 more month. I did the flooring work. Can I say my performance obligation is satisfied? No. Again, I took 1 additional month and I took the electrical work and plumbing work. Can I say my performance obligation is satisfied? No, because still I need to do which work? Wood work also. Once all things will be done. Now listen me. When all things will be done, right? At that day, the day when I will hand over the key to you, I would say my performance obligation is satisfied. Now guys, recall those points. I'm going to link those points. I said, if products are capable of being distinct, plus it can be distinguished. It can be distinguished in the context of the contract also, which means it's a separately identifiable. We would say more than 1 performance obligation is there. But if any one condition is missing, we will say there is a 1 performance obligation. Now tell me, now I'm going to apply. Are these services are capable of being distinct? Capable of being distinct. Can I sell normally? Can I sell these services separately or not? Yes, we can sell. But when you will look into the context of the contract, even these products are separately saleable. But when I will look in the context of the contract, these are not separately identifiable. These are not separately identifiable. The reason I have to complete the house. It means these are capable of being distinct, but these are not distinguished in the context of the contract. It means how many performance obligations are there? 1 is meeting, 1 is not meeting. Only 1 performance obligation. That is what? That is your house. House is the performance obligation now. Understood? So this is how you have to decide. You got my point? Now I'm going to show you examples. Don't worry. I know it is tricky. I explained distinct also. I told you how you will identify this 1 performance obligation or more than 1. When you will say there is a 1 performance obligation, guys, I'm repeating again and again because you should not be worried. If goods are capable of being distinct, but it is not distinct within the context of the contract. It means 1 condition is not meeting. So it is only 1 performance obligation. If it is capable of being distinct, but it is distinct within the context of the contract also, right? So then we will say there is more than 1 performance obligation. So let me show you examples if you feel like it is hard to understand. Once you will go through the data, automatically common sense will be applied. So I'm going to give you example here. This example we have. And we need to look from the question. Is it capable of being distinct? Can we distinguish from each other? If yes, is it distinguished in the context of the contract also? if it is distinguished in the contract, in the context of the contract? Answer is yes. It means there are more than one performance obligation. If it is not distinguishable in the context of the contract, we'll say there is a one performance obligation. Right? I'm reading a question with you, and I hope so you will listen me. A software developer enters into a contract with a customer to transfer. What we are going to transfer? Number one, we are going to transfer what? A software license. Software license is software copy. Comma, perform installation. Third, provide a software updates. Fourth is what? And a technical support. Four things are there. You can buy only a software. You can buy only an installation service from me, or you can buy only a software updates from me, or you can buy a technical support from me. Right? Right or wrong? There are four things are there, but let's understand. For how many years? Technical support is for 5 years. Okay. The developer, please look. Now here you will get those 2 points. The developer sells the license, installation, updates, and technical support what? Separately. It means first point is there. These are capable of being distinct because he can sell what? Separately. Right? And second, first condition is there. Second is what? The entity determines. The entity company has decided that each good or service is separately identifiable. Separately identifiable is the word for what? It is distinguished in the context of contract. In the context of contract, it is distinguished in that because he told you it is determined. You don't need to determine the question. He will give you idea. So they determined it is separately identified. It means in the context of the contract also these are separately identifiable. Both answers are yes. It means there are more than one performance obligation. So it means how many performance obligations are there required? Identify the performance obligation. Now guys, look. Do you remember? In the first point I told you capable of being distinct. I told you customer will get the benefit by their own or along with other products, right? Right or wrong? Yes, customer can take the benefit only from your software copy, only from update. He can get the benefit from only from technical support or only from installation. And in the context of the contract, these are 4 different things because these are separately identifiable. It means there are how many performance obligations? More than one. So these are performance obligations are there. Software license is one performance obligation. Installation services another performance obligation. Software updates is third performance obligation, and technical support is one performance obligation. Understood? So you have to look the words. Capable of being distinct and separately identifiable. Separately identifiable means say it is distinguished in the context of the contract also. If both conditions are there, it means there are more than one performance obligation. If one is missing, it means we have only one performance obligation. I'm repeating so many times. Okay, understood? That's it. Now guys, this was step number 2. Now I'm going to explain what? Step number 3. So step 3 is about what? Determine the transaction price. What is transaction price? Transaction price means simply sale price. We need to determine, right, the sale price also. Like what is the price which we are going to charge for the goods or services. That is called what? Transaction price. I don't think so it's something very hard. Even when you sell your car also, so you need to determine what price you are going to charge, right? We will not sell anything blindly. So this is what they are trying to tell you here. Transaction price. It is defined like that. Transaction price is the amount of consideration that you are going to receive something to which an entity expects to be entitled. Like an entity has a right to receive against what? In exchange for transferring promised goods or services to the customer. Right? Like whatever you are going to receive against the promised goods or services, that is called your transaction price. And here I have a quick question for you guys. I need your concentration. The transaction price, it excludes. It what? Excludes what? The amounts collected on behalf of third party. Example has written what here? Sale tax. I'm giving you example here. For example, you are selling a product for $100. This is sale price. But you are supposed to charge 5% VAT on that. So VAT is how much? $5. So how much you will charge from the customer? 105. Now when it comes to the counting, how much revenue you should book? Should we book revenue 100 or 105? 100. Because $5 is the VAT which you are receiving from customer, and later on you will pay to the government. So this is not going to be your revenue. So revenue will be only how much? $100. So that is why whenever you book this was the transaction price 105. So from here you need to remove what? Any amount which you are collecting on behalf of third parties. That amount should be deducted, and for remaining you have to book the revenue. Understood? So now remember this point theoretically. What is the point? The transaction price should exclude. Doesn't mean you will exclude from the customer. No, from customer you have to collect. But when you book the revenue, don't make the part of revenue. Okay? So transaction price exclude what? Amounts collected on behalf of third parties. Okay, sometimes there's another point, guys, because these points are having different accounting, by the way. Okay, so that is not required for us. So, but you have to understand here, any consideration means what? Payable to the customer. Let me give you an example here. For example, you bought a mobile from Sharab DG, mobile phone, and they gave you voucher for 100 dirham. 100 dirham. Okay, they gave you voucher, and that voucher can be used on the next purchases within 30 days. So it means this 100 dirham is the consideration payable to whom? To the customer, because they have given this voucher and customer can take the benefit of this voucher. Again, I'm reading, any consideration payable to the customer. It could be like coupons, credits, or vouchers. Reduce the transaction price. It means if you sold a mobile, as per this statement, what we understand, if you sold a mobile for 5,000, you gave a voucher for how much? 200. So transaction price should be how much? 4,800. Understood? Clear? Then point number 3 is what? This is important, and here we have some calculation. Please focus with me now. I need your concentration. Small calculations are there. Point number 3. Regarding transaction price. Point number 3 is what? To determine the transaction price. Like when you decide the transaction price, an entity should consider, the company should consider what? The effects of time value of money and what? Variable consideration. These are 2 key words are there. Like when you determine the transaction price, we need to think, is there any effect of time value of money? Okay, or variable consideration. So I'm going to deal with first with what? With the time value of money. Maybe you people, actually you should ideally have, because I'm not supposed to teach those things. You should have idea about how to get present values, future values, basic idea. So here is what we are going to talk about. That is called the fact of time value of money. Okay, so here what is the question? So there are two questions are there. There are two questions. It's written here. I will show you screen also. So I'm talking about, should we consider the effect of what? Time value of money, right? So I'm going to write it here. Otherwise, it is written there in the sheet also. If you want, I will scroll down the sheet later as well. You can go through for your satisfaction. So question I'm going to ask you. This is the first question. Please focus with me. Question number 1. And conditions I'm going to explain. Should we adjust? Should we adjust transaction price for time value of money? This is the question. Should we adjust the transaction price for what? Time value of money effect. This is the question. And there are two answers. Answer could be yes. Yes, we should adjust the transaction price for the effect of time value of money. Or answer could be what? No. I'm not going to explain anything about no right now. I'm just going to explain for yes first. Because then we will reverse the situation. We will get the answer for no. Understood? Yes. Yes, we should adjust the transaction price for time value of money. It means here what? What does mean by yes first? Yes means we have to record. We should record. This is the solution actually. We should record that this revenue at which value? At present values. At which value? This is what is the fact of yes. We should record the transaction at which value? At present values, not at future value. But the point is that when to adjust, when, right? What was my first question? Should we adjust the transaction price for time value money? I said yes. Yes means what? I have to record transaction price at, I have to record revenue at present values, for example, at present value. But when? What conditions are there? Condition number 1. Condition number 1. I'm telling you, if cash selling price is different. Cash what? Selling price is different. Different than what? Than transaction price. Okay? Or let me say this way, because I skipped one point here. Let me say this way. Yes, we will consider the effect of time value money. Okay, if there is a condition name, if there, this is the right sequence, if there is a significant, this is what you have to remember, if there is a significant financing component is there. What keyword is there? Yes, we will consider if there is a significant financing component is there. Financing component, simply you can say involvement of interest. What? Involvement of interest. That is called significant financing component. We can also say this way. Yeah, what does mean by significant financing component? If the entity is getting financing benefit, I use two words. I said significant financing component means say if there is an involvement of interest. Second word I used what? If there is a financing benefits for the entity. If involvement of interest is there, which is called significant financing component, it means we should adjust the transaction price for the fact of time value of money. Now the point is that when we will consider there is a significant financing component, then we will consider. So there are conditions, there are indications. Condition number 1. Now I'm writing, if cash selling price is different than transaction price. So what it is? If cash selling price is different than transaction price. I'm giving you example here. Please listen my example. I'm selling chair. If anyone will buy at cash, I can sell for $50. Now you are my customer. You said, no, I don't have a cash. I want to buy on credit and I will pay you after 3 months, or maybe not 3 months, maybe after 3 years or 2 years. Intentionally, I'm saying more than 1 year. 2 years or 3 years. I'm saying, okay, no worry, then I will charge you how much? 70. It means this is what is the transaction price which we agreed. But what is the cash price? Cash price is what? 50. It means intentionally, if the difference of cash selling price and the transaction price, I will treat as a financing component. I will treat as it is a interest. Understood? Whenever cash selling price, sir, is different than transaction price, it means there is a financing component. So we should adjust the transaction price. We should record the transaction price as per present values. Understood? Clear? Point number 2, which will indicate there is a financing benefit. There is a financing component. What is the point? Please let me write. If difference, sorry, I'm not writing complete words. If difference between delivery of goods and cash receipts. Cash means cash payments, you can say. Okay. If difference between delivery of goods and cash payments is more than, writing shortcut, is more than what? 1 year. This is the keyword. What it means here, you might have 2 scenarios. How many scenarios? 2, and we will see then how to deal with each scenario. Scenario number 1. Can you read the point number 2? What I said? If difference between delivery of goods and cash receipts is more than 1 year. For example, you are delivering asset in advance. Like delivery of goods is today. Delivery is what? Today. But customer will make payments in what? In future. Customer will make payments in what? Future. For example, and the difference is more than a year. More than 1 year. For example, is greater than 1 year. Let me give you example. For example, I have delivered goods you today, right? But you will make me payments after 3 years. It means delivery is in advance, but payments will be received in 3 years. So it means I will assume there will be a financing component. And please make a note in this scenario. Whenever delivery in advance, from seller point of view, interest income will arise. What will arise? Don't forget, intentionally I'm writing these words. What will arise? Interest income. Why? I'm giving example. Just this is rough example, I know, but just to make you only understand. For example, I spent $200 or $2,000 on chair. I sold it to you for the credit. It means you are using my money for 3 years now, right? Because you are going to make me the payment after 3 years. So what I should charge? I should charge interest from you. For me, it is going to be interest income from seller point of view. Because you are going to pay interest. Because there is a financing benefit for you. Understood or not? So for you, it will be interest expense. But we are talking about seller point of view. For him, it will be a interest income. How you will calculate? This is another scenario. Point number, another point, sub point. Again, the difference between what? Delivery of goods and cash receipt is more than 1 year. And here, what could be the scenario? So you are receiving payments in advance. You are receiving, guys, You're receiving cash in advance, but you will make the delivery in future. Delivery when in future. And again, difference between these two points is more than 1 year. It means what's happening here. Look from seller point of view. Seller is going to collect cash today. For example, I got a cash from you today, but I'm telling you, sir, I will deliver goods after 3 years. It means I'm going to use your cash for 3 years. Understood? There is a financing benefit for me, for seller. So as a seller, what I should do? Should I calculate interest income for me or interest expense? I should deal as interest expense. Like if you think, oh, it's like I'm using your money. So I have to calculate what is interest expense in this scenario. How it will be calculated, I'm going to explain with the help of example. Don't worry. So there are two scenarios. Number one, because each scenario accounting is different. If delivery of goods is in advance, payment is later, it will be dealt in different way. If payment is in advance and delivery is in future, it will be dealt in different way. So that is where wake up now. So I'm going to show you how it is going to work. Right? So I'm going to show you with the help of example. So here we go. We have example here. If you look at here, this example is for what? Advance delivery. Like you are going to deliver goods today, but you are going to collect cash in future. But difference between these 2 points is more than 1 year. Understood? And I would request you please go through this example from here till here. Just read carefully what data is given. You ready to the example? So what they're saying, on January 1, what? Year 1. Biff company sold and transferred a machine. So see, machine is transferred. It means as a seller, your performance obligation is done, satisfied. It means you can book the revenue or not. Please listen to what I'm saying, it's important. Revenue will be booked only once your performance obligation will be satisfied. And you can see in this question, so you have delivered the machine. Even cash will be received in future, but revenue I can book today because my performance obligation is satisfied. Right? So we deliver the goods to a customer for how much? 583,200. Actually, this is the transaction price. We sold for 583,200. That is payable, but this amount will be payable on December 31st, year 2, right after 2 years. The amounts will be received. Understood? It means it's advanced delivery and payment will be received in future. Difference is more than 1 year. It means there is a significant financing component we need to consider. And in this scenario, interest income will arise or expense will arise in advanced delivery. Interest income will arise. Okay, then he told you what? Other customers, see what it's given here. Actually, this is transaction price. Huh? Other customers pay $500 upon delivery of the same machine at contract inception. What it is? Actually, it is the cash price. We are saying if the customers are paying immediately, so they are paying how much? $500,000. It means this is the cash price. And obviously, cash price is different than transaction price. The difference is 83,200 is the difference. It means this is your interest income actually. Understood? Clear? Then what you have to do? The cost of the machine to BIF is how much? 400. Actually, the cost of machine is 400, but you sold it for 583,200, and the cash price of that product is 500. BIF determined that the contract includes a significant financing component. There is an interest element he told you. Okay, because the difference between consideration, which is transaction price, and what the cash selling price. You are saying it determines there's interest we are charging. And now, guys, the contract includes implicit rate of interest. How much? Like they are charging interest of 8% actually. It's given. Okay. For how many years? 2 years. Then what entries you will pass? Guys, now understand the entries. The day when asset is transferred, it means seller's performance obligation is satisfied. So seller can book the revenue because we delivered asset in advance, goods in advance. So what we will do? We will debit what? Account receivable, and we will credit what? Revenue. With which price? With the cash price. Which price? Actually, this cash price is the present value. And present value, how you got it? Maybe it is written here. I'm not sure if you have idea about it or not. But actually, this is the present value. Cash price we assume here, present values. And how you get the present value? You always need what? Transaction price multiplied by which factor? Present value factor. At which rate? 8% for how many years? 2 years. And you know, there are tables are there for present value factors. Okay. And there's a one table which is which name is $1 present value factors. This is the name of table. Present value of $1 table. This is the name of table. Okay, just you will go to that table, put the transaction price here first, 583,200, and go to the table, look at 8% for 2 years. Okay, you will get this factor there. Okay. If you are non-finance background, don't worry. You will book the entry with the cash price simply. But once you will multiply these two, this will give you present value equal to 500,000, which is your what? Cash price. Understood? So what we have done here, we have to debit receivables, credit revenue, it's a sale with cash price. Understood? And it is the rule of accounting. When you book the revenue, same time you have to book the cost of goods sold also. Right? So what entry you will for the past, you will pass for the cost of goods sold. You will debit the cost of goods sold, credit what? The machine inventory with the cost information. Cost was 400,000. Understood? This is the entry. These two entry you will pass when at the time of sale, delivery of item. Now, at the end of the first year, because customer will pay you after 2 years. At the end of second year, he will pay you actually. Now, at the end of the first year, you will pick the value of total receivables. Like what is the value of receivables? Look from these two entries. What is the value of receivables? Look from these two entries. Receivable value is how much? $500,000. And you will multiply with which rate? With the 8% to get the interest income. And once you will take 500,000 times 8%, this will give you how much? 40,000. And what entry you will pass? Debit account receivables. Still you are booking receivables because it's not yet received. And credit what? Interest income, not revenue. Interest income you are showing. Then you will wait another 1 year. And for the second year, you also will calculate the interest. Again, rule is what? You have to calculate the amount, interest on amount of receivables. Now, total receivables are how much? 500,000 a year. You can see here. And how much? Here also you have receivable. How much? 40. So total is how much? 540 times what? 8%. So this will give you another interest. How much? 43,200. Again, you will pass the entry debit, receivables and credit, interest, income. Okay? Interest, income. And now at the end of second year. At the end of second year, once customer will pay the money, what you will do? You will debit the cash. Now see, because this is what total receivables now, how much? 500,000 plus 40 plus 43,200. It becomes equal to the transaction price. Right or no? You will debit what? Cash and credit what? Account receivable. This is how transaction will be settled. This is how you will deal with what? With the advance delivery. Right? And in advance delivery, what will arise? Interest, income will arise. Now we are going to deal other way around. What if we are getting cash from a customer in advance, but we will deliver the goods in future. It means here there is a financing benefit for the seller because he is using the customer's money for 2-3 years. So what he will charge? He has to show interest expense, right? So how it is going to work? Let's have a look with the help of examples. I would request you, please go through this example. Let's read this data, guys, from here till here, please, quickly. You read it? So what they're trying to tell you guys, so here they're telling you on January 1, year 1, like start of the first year, start. E company received a payment. We received what? A payment of 100,000. Today we got a payment for delivering a machine to a customer at the end of year 2. Machine will be delivered at the end of year 2. So it means there is a duration difference between receiving of money and delivery of item is more than 1 year. Actually, it is 2 years. Because today you are getting money, after 2 years you will deliver the asset. When revenue will be booked? Today or after 2 years? When your performance obligation will be satisfied? After 2 years. It means revenue should be booked only after 2 years. So whatever cash you got today, you have to book as a liability. Understood? So then they're telling you the cost of the machine. Again, the cost of machine is what? 70,000. So there is no transaction price is not given. We will calculate now. So the EVA determined that contract includes a significant financing component. They are saying there is interest component. Interest component, why? Like we are using their money. So they are saying like we will be like treated as a interest expense. And the financing rate is how much? 10% rate is there. Because EVA, if he will take loan from the bank, he has to pay 10%. And now he's using money of customers, the same 10% he will use as the interest expense calculation for interest expense calculation. They're saying 10% is the appropriate discount rate. The following entries should be recorded. What entries? Let's do it. Today, 1st January year 1, need concentration, guys. Don't make it complicated. It's easy. At the start of year 1, you received cash in advance. So what entry I will pass? Debit cash, credit, contract liability. I will not book here credit loan payable. No. I will use the word contract liability. Reason, because this payment is conditional. I have to deliver the goods. So whenever conditional is there, so we should book as a like a liability. Contract liability. Okay, don't book as a loan liability. Okay. What? Contract liability. Its liability is rising due to that contract. So how much is the money you have received? 100,000. There is no doubt in that. Now, guys, at the end of first year, because goods will be delivered at the end of second year, at the end of the first year. So now you have booked this liability. On this liability, you will calculate the interest. Previously, we were calculating interest on receivable. Here you are calculating interest on liability as expense, right? So interest liability is how much? 100,000. And what's the rate of interest? 10%. So it will give you how much? 10,000. So what entry you will pass? Debit interest expense and credit what? Again, contract liability. Understood? By 10,000. Now at the end of second year again, one more time you have to calculate interest expense for the second year. And what is your liability total at the end of second year? You have booked this entry with 100,000 as a liability. You have booked this entry at the end of first year. So total liability will become how much? 110,000. Okay. Multiply by which amount? 10%. So this will give you how much? 11,000. Again, you will pass entry debit interest expense credit contract liability. Because mostly when you calculate the interest, you always take what is the beginning balance of liability at the start of the year, right? So if you're sitting in year 2, so what is the ending balance of year 1? Will be the beginning balance of year 2. Ending balance of year 1 was how much? 100 plus 10. It will become beginning for year 2. On that I have to calculate interest. Understood? So what you will do, so you will book 11,000 again as interest expense and credit contract liability. Now 2 years are passed and I'm assuming you have delivered the assets at the end of second year. Performance obligation is satisfied or not? Yes. It is satisfied. It means I can book the revenue now. But how I will book the revenue? I will debit what? No, first I will debit the contract liability, which I was creating for this contract, which includes the fact of financing component, and credit what? I will take to the revenue. Okay. And then what was the balance in the contract liability? 121. How you got? 100,000 here, 10,000 here, 11,000 here, 121,000. We will debit contract liability and we'll take it to the credit revenue. And what same time we will book what? The cost of goods sold. Cost of goods sold. What was the cost of the item? 70. You will book the cost of goods sold, credit the inventory by 70,000. Understood? This was all about when to consider the time value of money. Okay, and if answer is yes, so this we have discussed. Then we will consider the time value of money if there is a significant financing component, and when we will assume there is a significant financing component, if cash price is different than transaction price, or if the cash receipts and the delivery of asset, the difference between these 2 points are more than 1 year. There could be advance delivery and later on we are going to collect cash. There could be advance payments and later on we can deliver the goods. Both cases we have discussed. Now I'm going to answer when. When. Not this again theoretical points. You have to remember to solve theoretical question. When not to consider time value of money. So 3 points we have to understand. Like you do not need to consider, you do not need to calculate any present values. You do not need to calculate interest expense or interest income in the following conditions. Which conditions are there? Number 1. The time between payments. Payment means the cash receipts. And what? The delivery of the goods, okay, to customer is 1 year, or if it is exactly 1 year or less, you do not need to calculate any present values. You do not need to show any interest expense and interest income. Understood? Previously we were saying delivery of items and receipts. The difference between these 2 points is more than 1 year. But now if difference is 1 year or less, no need to adjust. Point number 1 is clear. Theoretically, you have to remember this point. Okay, especially things which I am highlighting. So because it will help you to solve a lot of theoretical questions. Second is what? Point number 2. Look here, and I will change the words later. The customer paid in advance. Very good. Customer has paid in advance, and transfer of goods or service is at the discretion, the choice of the customer. For example, I paid you the money. I'm buying chair from you. I paid you the money. I'm 100% paid the money. I'm saying, sir, please keep this chair with you. Once I will return back from Abu Dhabi, I will take it. Maybe now you don't know when I will come. Maybe I will come tomorrow, day after tomorrow. Maybe I will not come 1 month, 6 months. Now you have a question in your mind. You are thinking, sir, I will keep this chair with me. But if anything will happen, I'm not responsible. And as a customer, I agree on that. I said, no problem. Take the payment, keep the goods, I will take it. It means now what happened here? Payment is in advance. But the transfer of goods or service is at what? Discretion of the customer. If this scenario is there, maybe even customer will come after 10 years. Still, you don't need to consider time value of money. Understood? Clear? regardless of the point, regardless of the duration now, if he told you payment is done and the delivery of item is on the choice of the discretion, so we do not need to consider time value of money. Can I say here question? I'm saying that customers paid in advance and the transfer of goods or services is at the choice of the supplier. This is wrong statement. Choice should be with whom? With the customer. Sometime he will tell you, is it true or false statement? And here the word customer will be replaced with the supplier. It will become false statement. Choice should be with whom? With the customers. Understood? Third point. You do not need to consider time value of money if consideration is what? Variable. This I have to explain. Theoretically, I will explain. Otherwise, I will record one video on variable consideration. It's not in CMA, by the way. Okay. Otherwise, I will record complete video on variable consideration, different examples, how to deal it. So, but you have to remember theoretical point. Let me read this point first. I will explain theoretically what is variable consideration. Don't worry. But it has so many calculations. Even those calculations are included in the sheet if you want to go through by USM. Otherwise, for exam, not necessary. Point number 3, when not to consider time value of money. A substantial amount of consideration is what? Variable. What is variable consideration? I'm giving you example, please. Try to understand my example. Variable consideration means to say, for example, if I will book any amount of revenue today, this is what I'm saying. For example, I'm booking revenue of $100 today, and it has a chance. It has a chance. This value might change in near future. It means this consideration is what? Variable. Let me say again. I'm just giving you a rough idea first, then I will give you proper example. I'm saying, for example, I have booked a revenue of 100, but it has a chance. Maybe in future it will be reversed. This 100 will change. It could be 80, 70, or 120. It means then this consideration is variable. How it is variable? Let me give you example. For example, I sold 20 chairs to you. How many chairs? 20 chairs for 50 each. Understood? And I gave you, you are a customer, you are my customer. I gave you right to return. What I gave you? Right to return the goods. If goods are not fit for purpose, or if it is defective, you can return. You have a right to return within how many months? 3 months. Within 3 months. Now see, I will be confused here. If I will book revenue, today if I will book revenue for 20 chairs, 20 times 50 for $1,000, maybe after 1 month, you will return 4 chairs to me. This revenue amount will change or not? Right or wrong? Maybe you will return me. Maybe I'm expecting you will return me 4, but you have returned me 3. Again, it will affect the values. Maybe I was expecting you will not return anything, but you returned. Again, it will affect the values. Maybe I was expecting you will return, but you didn't return. Again, it will affect the values. Right or wrong? By the way, we have a proper accounting how to deal with the rights of return. Example is there. I have included everything, but I'm giving you just rough theoretical examples. For variable consideration, you can see, for variable consideration, first variable consideration could be what? Refunds due to rights of return. Even I have included the example in this page, in this sheet. Rights of return, how to deal with rights of return. It's written here, not in CMA. You don't need to worry about it. I have included the examples here. Everything is there. But no need unnecessary data. Understood? For other students, I will try to make the video for variable consideration separate. And I will explain it. And there is another example for variable consideration. Okay. There's another example for variable consideration that is called what? Like for example, prompt payment discount. You know, early settlement discount is there. Early settlement discount. Sometimes we offer the discount to the customer. If they will pay within specific days, we offer the discount. It can also change my revenues. Right or wrong? Depending upon customer will take the discount or will not avail the discount. It is not under the control of seller. Right or wrong? Can I control you? Can I force you to take discount? No. Even sales with rights of return, it's not under the control of seller. He will return or not, it is not under the control of seller. Third, it could be volume discount. Maybe I can give you volume discount also. Like today you bought, for example, 100 chairs, and I told you if in 1 year you will buy 200 more chairs, I will give you another discount in the price. Right or wrong? And I will reduce the price for old chairs sold also. Right, so due to this, my consideration can change. This is called what? Variable. There are a lot of factors due to that variable considerations. Considerations could be variable, right? And for each point, you have a trust me, we have accounting, separate accounting, but it is unnecessary for you. Just remember the examples of what is variable consideration. Okay, due to which consideration might change. Whatever revenue you have booked, it might be reversed. And you might increase the revenue later on, or you have to decrease the revenue, so but consideration will change. And the consideration will change, okay, due to the customer's action. And that customer's action is not under the control of seller. Remember this point. I'm taking you back to that point where we were discussing when not to consider time value of money. So I told you 3 points. Point number 1 is what? Let me repeat. Point number 1, when not to consider time value of money, when difference between payment and delivery of goods is 1 year or less. Second is what? When customer paid in advance, but the transfer of goods or service is at the discretion of customer. Point number 3 is what? A substantial amount of consideration promised is what? Variable. Now read the next part. And its amount of consideration or timing varies, because we don't know when customer will come. Will he come to take discount? Will he come to return the goods? Right or wrong? And the amount, all the timings vary with what? Future circumstances that are not within the control of entity or maybe the customer also. Because customer, how we can say product will be defective? Maybe products are not going to be defective. Right or no? If consideration is variable, again, we do not need to consider time value of money. For your exam, simply have to memorize these 3 points, 1, 2, and 3, which will indicate not to adjust the transaction for time value of money. It's not necessary all these 3 things should be there. If any one condition is there, you do not need to adjust transaction price for time value. Understood? So step 3 is over. Moving to the step number 4. What was the step number 1, guys? Identify the contract with the customer. What was step number 2? Identify the performance obligation. What was step number 3? Determine the transaction price. Transaction price should exclude VAT. Transaction price should be reduced by vouchers discount. Transaction price should be adjusted for time value of money. Answer was yes or no. Right or wrong? And variable consideration, I already told you what is variable. Understood? Now guys, step number 4 we are going to discuss. Step 4 and next I need only maximum 10 minutes. It is going to be over. What was step number 4, guys? Need concentration. What was step number 4? Allocate the transaction price to each performance obligation. And guys, look how it will be allocated. Simply let me give you example. Sometimes we sell goods as a package. For example, as a tuition provider, we are selling lectures, plus we are selling study material, let's assume. But we are charging one amount from the customer for both. For example, I'm saying I'm charging, let's say, $1,000. Now I need to split how much money should be allocated to the sale of lectures, how much money should be allocated to the sale of books, material. So this is called allocation now. And how it will be allocated, I'm going to show you with the help of example. It will be easy. So here we go. For that, guys, you have to read this question, please. Can you read this question, guys? Till here. Just go through, please. Done. Actually, what happened? We sold two things. What? Machine and maintenance service. And we sold for how much value? $200,000. But if you will sell only machine, the market value machine is how much? 160. This is called standalone price. If you will sell individually. If you will sell only maintenance service, price is how much? 90. If you will club these two values how much? 250. But we sold for how much? 200,000. So what I will do, this $200,000, I'm going to allocate now to the machine and to the service. How I will allocate? Based on market values. Based on what? Market values. Market values is standalone prices. How I will do? I will make a formula. Just I will write first performance obligations. We have how many performance obligations? Two. We have a machine and we have a maintenance service. And I will write here next column what? Their standalone selling prices. Standalone prices, which is 160 and 90 given here. 160 and 90. Make the total. And I will convert into percentage. How? I will take 160 divided by total. Multiply by 100. It will give me how much percentage can you calculate? Otherwise, I can allocate this way. 160 divided by total. What was total of market value? 250. This will give you fraction. And then I will multiply with the transaction price. What was the transaction price? $200,000. Automatically, the amount will be allocated. How much amount will be? 128,000. Now I want to allocate to the B. It was 60% first? 64. Okay. So now if you will allocate the second, I want to allocate to the maintenance. What I will do? I will take 90,000 divided by total. What is how much? 250. And I will multiply with how much? With 200,000, which was my transaction price. It means what I'm going to do for allocation. I'm taking market value of the product divided by total market value and multiply by what? Transaction price. So this will give me allocated transaction price. Understood? Clear? It means how much will be allocated to machine? 128,000. And how much will be allocated to maintenance? 72,000. Machine is allocated, but machine is delivered, right? Delivered or not? Delivered, but maintenance service will be, I did it right, I'm asking you. It is delivered, right? And maintenance service will be delivered, will be provided over 3 years. Right? It means if I want to pass entry, just entry I'm asking. What entry you will pass? You will debit cash. You got how much? 200,000. You will credit what? Revenue from machine. How much value? 128,000. And you will credit unearned revenue or contract liability for how much? Liability for how much? 72,000. This is how it is allocated. Understood? Can I ask question now? Because I know I'm sharing information, it's maybe too much for you also, but you need to know to solve the question. What if, asking question, what if these standalone prices are not available? Again, we have to allocate transaction price. We have to allocate transaction price to each performance obligation. Even standalone prices are not given. How you will allocate or how you will estimate the prices then? This is my question now. So here standard provides you 3 guidelines. Guideline number 1. First, priority. If sale prices, like as it was given there, 190 and something, 160 or 90. If sale prices are not directly observable, standard it must be, you have to estimate. And standard gives you guideline to estimate. What's the number 1 point? You have to take what? Adjusted market assessment. What it means. For example, I want to sell laptop, but I don't have standalone price. Adjusted market assessment means say I need to think if I don't have actual market value here, right? I need to think if I will sell this laptop to the customer, how much he would be able to pay or how much he will be willing to pay. So that value I can use as a standalone prices. Understood? Again, it is what? Estimate. The word is, it must be estimated. So what is adjusted market assessment? Look, an entity evaluates the market in which it sells goods or services and estimates the price that the customer in that market would be willing to pay for them. You should estimate. Second is what? Maybe there is no market for that. Then what? You need to think this way. Because I want price for laptop, price is not there. I can think this way, even I'm not engineer, but I can think this way. For example, if I will make this laptop, manufacture this laptop, how much it will cost me? It could not be a laptop, it could be a house also. We can think if I will manufacture this house, if I will construct this house, so what cost I will incur? Oh, I will incur cost of 1 million. Okay. Okay, so normally if I will charge 10% profit on that, which is 100,000, so it means my price should be how much? 101.1 million. Understood? This is what is called expected cost plus appropriate margin, like estimate the cost, add profit. This will be your selling price. If this is also not working, this is also not working, then you have to use which approach? Residual approach. What is residual approach? It will work only in that scenario. For example, I am selling machines. I sold machine plus maintenance service for $200,000. Market value machine is available 190,000. Market of technical services or maintenance service is not available. So what I will do now? I will take transaction price, which is 200,000. From there, I will allocate to the machine how much? 190,000. Remaining, what is remaining? Residual. Residual I will allocate to the maintenance service. It means this much money I can take it to the machine, this much money I can take it to the maintenance service. How many approaches are there? 3. Adjusted market assessment, cost plus appropriate profit margin, and residual. For residual, at least market value, one thing should be missing, right or wrong? And market value, other thing should be available. Then I can apply the residual approach. Understood? Now, guys, this is how to allocate the transaction price. Now, guys, we are going to discuss last step number 5. There are some extra examples, but we are running with the short of time. Step number 5 now. Step number 5 is what? Last step. Recognize revenue. You will book the revenue. You will bring it to the financial statements when or as performance obligation is satisfied. Please learn now what I'm telling you. When we will assume performance obligation is satisfied. Okay. We will assume here, please have to read this information because it is theoretically very sound and important to solve theoretical questions. When we will say performance obligation is satisfied, number one, an entity recognize revenue. One or as it satisfied the performance obligation, we know this is the heading, by transferring a promised goods or services, or it would be asset to a customer. Not good point. The good point is an asset is transferred. Look, what I'm repeating again, linkage is important. We will assume that performance obligation is satisfied when asset is transferred. And when we will assume asset is transferred? When we will assume that asset is transferred? Asset is transferred when the customer obtains the control. This is the key word. In simple words, performance obligation is satisfied when the control of the goods is passed to the customer. What does mean by control now? Control mean to say he has the ability. He has what? The ability. He means a customer has the ability to direct the use of asset. He can use anytime, anywhere, whenever he wants. His ability to direct the use of asset. Plus, he obtains substantially all of remaining benefits from the assets. If two conditions are there, customers can direct the use and he will be the one who will receive benefit. It means control is passed to the customer. It means performance obligation is satisfied. Understood? Right? And now next question I'm asking. When we will assume, because there are indications, when we will assume that control of the asset is passed? How we can see? Because if I'm giving you mouse, I gave you mouse, how I would know the control is passed? There is no certificate for mouse. It's just for $1-2. Understood? So that standard guides you. There are some indications which will show you that control is passed and you can book the revenue. And what indications are there? These are the indications. These are indications that control has passed to the customer. Number one, the entity has present right to payment for the asset. I sold you the laptop. Now I have a right to receive the money. It means here asset is delivered and it gives me the right to receive money. When we have a right to receive the money, right or wrong, it means control is passed. We will assume, I'm not saying 100%, we will assume that control is passed. Second is what? The customer has legal title to the, for example, I'm selling you land, or I sold you car, and title is transferred. It means control is passed now. It means my performance obligation is satisfied. I can book the revenue. Point number 3. Entity has transferred what? Physical possession of the asset. Maybe this mouse I'm selling you. No title is required. Physical possession is handed over. I will assume control is passed. Or it could be customer has significant risk because goods is with you now. If anything will damage your asset, you are responsible. If there is any appreciation, you will get rewarded. Right? It means risk and reward of ownership is also passed. It means control is passed. Last, the customer has accepted the asset. He has accepted. Okay? He has accepted it. Even his asset with you. He told you that it is my responsibility. It means we will assume control is passed. These are indications. When you will book the revenue, when our performance obligation is satisfied. Can I ask question? You are airline industry. Customers bought the ticket in advance from you. Right? At the time of purchase of tickets, can airline industry book the revenue? No, why not? because his performance obligation is not satisfied. What is his performance obligation? He has to provide you the flight. Unless flight will not occur, they cannot book the revenue. Understood? It means whatever they are receiving, collection from the tickets in advance, so far it is their liability till the point when the flight will occur, so they can book the revenue. So now another example, because I want to just wind up. You bought an item from grocery. Immediately, seller sold you goods, you paid the cash. He can book the revenue, right? Why? Because his performance obligation is satisfied. He delivered the goods. This is called performance obligation is satisfied in point in time, immediately. Whenever performance obligation is satisfied, you can book the revenue. So sometimes performance obligation will be satisfied over the years. Many years it will take, like especially in construction projects. So then how to book the revenue, we will study in the next class. Thank you so much, guys. If you have a question, you can ask me. Otherwise, thank you so much. Bye-bye.